Please, stop like this. Okay. So the last element we need when it comes to a final account is the balance sheet. And when we talk about the balance sheet, it simply means finding out or figuring out the position of the business. Where do we stand as a business? So to know where we stand as a business, to know the worth, the value of our business, we need what? The balance sheet. So what does the balance sheet comprise? It comprises the assets, the liabilities, and the owner's equity. So for the assets, we're talking about resources that belong to the business. We have two types of assets. We have current assets and non-current assets. It is non-current assets or fixed assets. Why do we call them current assets? We call them current assets because these resources are expected to last within a year. Stock, cash, bank, trade receivable, all these will be within a year. We have non-current assets. These resources are expected to last longer than a year. Equipment, machines, building, land, they are expected to last more than a year within the business. Then we have liabilities. What are liabilities? These are the debts to the third party. We use these things, but they do not belong to us. We use them, but it is not for us as a business. So we have current and non-current. It is current liability because these resources, we are expected to pay them back within a year. Debts that we have to pay back within a year. Non-current liabilities. For non-current liabilities, they are expected to be paid back after a year. Is it clear? Good. Is it clear, please? Yes. So that's current and non-current. Then we have capital or owner's equity. This is the amount of money invested by the owners of the business. We call it capital. So most of the time, our assets is always equals to liabilities plus capital. Asset equals to what? Capital plus liabilities. So your total capital liability must be equals to what? The asset of the business because you use everything for the business. Is it clear? And the last thing you have to understand is drawings. If the owner of the business puts money into the business, it is capital. If the owner of the business takes money from the business, take goods from the business, we call it drawings. So, if the owner of the business takes goods from the business, it is part of your trading account.
Yeah.
You less it from your trading account.
The drawing is part of the trading account.
If it was goods,
yes.
but if it is money, it is part of this. You take it away from the capital, which is from the profits. You make the profit, right?
Yeah.
Your profit is transferred to your balance sheet, yes or no? So the profit, you have to less drawings from it.
Okay.
If the owner of the business takes money from the business, you less it from the profit. If you take goods, you take it away from the purchases. Is it clear? But what we have to understand is that sometimes the owner of the business might take things out of the business, and when it does, it is called drawings. Is it clear? So in the next class, we're going to go into accounting equation. Thank you. Yeah.